Markets are closing the trading week, which has been full of events and macroeconomic data. At the beginning of the week, the market boost was triggered by political uncertainty in the US after Joe Biden had dropped out of the presidential race. On a Monday evening, the turmoil was settled and the currency market calmed down. Later in the week, US mass media rushed into speculating about the high odds of a rate cut at the nearest Fed Reserve's policy meeting, as early as this month. Curiously, in a midweek, this issue took a backseat. Yesterday, investors got to know the unexpectedly high growth rates of the US economy. GDP expanded by 2.8% in the second quarter. And today, the economic calendar contains another report on the PCE price index, the preferred inflation barometer for the Fed Reserve. Hence, markets will figure out how reasonable it's to expect such an early rate cut. Today, the markets are likely to trade quietly, first of all ahead of the weekend and also in anticipation of the meeting of the Federal Open Market Committee, which will take place in the middle of next week on a Wednesday. The media will probably become rigorous on a Monday with countless forecasts and discussions on the monetary easing by the US Central Bank. In contrast, on the other side of the Atlantic Ocean, no one has questioned the rate cut issue in the Eurozone for a long time. The EU economy is in dire straits and needs more affordable loans. Amid such fundamentals, the US dollar is now having an advantage over the euro. The euro-dollar pair is on a track to close the week 100 pips up. The instrument has stalled its rise at about 1.0825. Analysts admit a decline to 1.0800. However, the overall trend remains bullish, so it makes sense to check the chart for possible support levels from which traders will add more long positions on the euro-dollar pair. Yesterday, crude oil not only continued its decline but also dropped to almost $80 per barrel. A spike followed later on. As a result, the Brent price jumped above $82 per barrel, and the rise in oil prices was triggered by stronger than expected GDP growth in the US economy. Apparently, this is just the beginning of a correction that has been brewing for a long time. Curiously, the whole recent decline in oil prices ran despite data on the US oil inventories, which have been rapidly shrinking. The odds are that in a few days we will observe a steady rally in the oil market. The Russian ruble again amazed market participants with its strong performance. The dollar eventually dropped to 85 rubles. At first glance, this could be explained by today's policy meeting of the Bank of Russia, and the bank is widely expected to hike the key rate from 16% to 18%. However, market participants have priced in this policy decision for some time. Besides, investors are likely to view such a sharp rate hike as a negative factor that hinders the development of a business and the broader economy, so another round of monetary tightening is likely to weaken the ruble. To sum up, the current ruble strength is caused by a sudden increase in the currency supply during the tax period. The assumption that the season reached its peak the day before turned out to be wrong. However, in the previous 2 days, the scale of the ruble's rally was so significant that there is no doubt that the current ruble strengthening is local and speculative in nature. This is proven by the fact that even with the more stringent requirements for selling export proceeds, such robust moves have never been observed, and thus we conclude that after the decision on the key rate is announced, the dollar-ruble pair will rebound to 87. You have watched the Forex Trader. You have watched the Forex market review on a InstaForex TV channel. We wish you profitable trading. Have a nice weekend. and see you on Monday.